You can ignore the IT falling, you can ignore mid caps correcting. But if bank starts slipping, you shouldn't ignore that. So tell me honestly, if the bank Nifty weakens, are you prepared for what follows? This is where investors misunderstand the market structure because banks aren't just another sector, they are the backbone of liquidity. And by the end of this video, you'll understand why banking weakness is different, whether credit growth is slowing, why valuations get sensitive here, and what signal confirms a structural risk. Stay till the last section. That is where the confidence test happens. Banks control the credit drives the expansion drives the earnings justify the valuation. If banking stocks weaken significantly, it signals confidence shifts. Markets can rally without IT. Markets struggle to rally without banks because financials anchor the index stability. When banking leadership fades, momentum fades with it. Banking stocks are priced on loan growth, asset quality, net interest margin, credit expansion. If the macro pressure builds, rupee becomes weak, oil high, inflation sticky, then rate expectations shift. If rate cuts delay, margin expectations adjust. If growth expectations soften, valuations compress. Banks are sensitive to economic cycle more than most sectors. So, is the credit slowing? Now, there's an important distinction. Peak stock price doesn't automatically balance sheet, but markets anticipate the slowdown. If the credit growth cools, bank earnings projections adjust. The corporate borrowing slow, risk appetite reduces. If retail lending growth moderates, valuation premium shrinks. Markets price forward, not backward. So weakness in bank nifty could reflect the expectation reset, not crisis, but reset still moves prices. Now, healthy rallies have strong leaders. In India, those leaders are often banks, IT, large caps. If IT is weak, if mid cap is volatile, if banks hesitate, leadership vacuum forms. Vacuum increases fragility. Fragility increases the volatility. Volatility increases the fear. That's how corrections deepen, not instantly, step by step. So, this 2018 or something else. In 2018, NBFC stress hurt the financial confidence. Today, the situation is different. Capital adequacy is strong, asset quality has improved, but valuations have expanded, expecting stability. If the macro risk rises, premium compresses. Premium compression can occur without the crisis. That is subtle but powerful. Markets don't need disaster, they need doubt, and doubt reduces the multiple. So, what to watch next? So, we can track the credit growth data, NIM commentary, deposit growth trends, bank nifty relative strength. If the banking stabilizes, confidence stabilizes. If banking breaks support decisively, volatility probability increases. Leadership stability means market stability. That equation rarely falls. If you have been ignoring the banking signals, don't. Because markets forgive sector weakness. They don't forgive the leadership weakness. Most investors stare at the Nifty. Few stare at Bank Nifty. If you want to understand where confidence breaks before the headline scream, subscribe. Because structures move first and banks move the structure.